Results revenue at 3.17 billion euros, up 4.2% year over year.
Reporting third quarter sales up 4.8%. Franklin Golf Romeo.
The Fed policy will be driven by the pace of the data. Same policy will remain accommodative.
Futures off to sessions low, still down about 1% on the day for a little more than 4 pennies.
We're going to go ahead then and get started, and I'd like to welcome everyone to our webinar today. We have this weekly webinar on Tuesdays normally called the Options Tribe, but today is a special presentation and a special guest, John Locke, and he's going to be taking over momentarily. John, as many of you know, is an options educator, world-known, world-renowned, and he's also a very successful trader on SMB's options trading desk. The strategies we're going to be discussing today are strategies that are traded very heavily by the people on our options trading desk. So I guess you'd say we're putting our money where our mouth is, and I would say that everyone would agree that that has been a successful venture so far. So, this is a very important webinar for me and for hopefully the rest of you. I hope you learn a lot from it. And so with that, the long-awaited M21 options trading system is officially available to the public. And John Locke, please go ahead and start the presentation.
Well, thank you, Seth. Welcome, everybody. Thanks for joining me today. For those of you who don't know me, and Seth kind of went over this a little bit, but I'm John Locke. I'm president of Locke in Your Success, and I'm a trading coach and trading performance coach and mentor. I'm also an educator with SMB training, and I'm the developer of the M3 Bearish Butterfly, RUT, and the M21 trading systems, as well as a professional trader on their desk where they do trade some of the same strategies that we're going to be talking about today. All the strategies that we will be discussing today are designed to be traded on the Russell 2000. However, the concepts apply to all options trading in general, and the systems can be traded on other indices as well as higher price stocks if you make certain modifications to them. And the concepts are all the same, and they work well. Before we get going, we do have a quick legal stuff to go over. And we're just going to let you know that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And we are using hypothetical computer simulated trades that are believed to be accurately represented as possible. However, live results can vary from time to time. So just keep that in mind. Excuse me. What we're going to be going over tonight is the roadmap to the M21. We're going to just start out really, really simple, and we're going to really scale up fast in technical knowledge. We're going to start talking about income trades, the search for the Holy Grail. We're going to look at trading by the Greeks, look at what dynamic Greeks are versus static Greeks, and then we'll go through each of our systems to show you how we put them together to help people become successful traders. So starting with market neutral income strategies, that's the type of trades we're going to be discussing tonight. They're high probability complex option strategies that are also known as market neutral or income strategies, and I'm going to use those terms interchangeably. Now, by an income strategy, I mean trades that utilize the selling of options so that we can make money as time goes by, rather than depending on price movement to give us a profit. The great part about these trades in general is that they often make money in up, down, or sideways markets, and there are a lot of strategies out there that have really good win rates. And that's really cool. So for you directional traders that have joined the meeting today, you might not be familiar with this, but this is what a typical income trade called a Condor might look like. We have our profit and loss on the vertical scale. On the left side, we have a price of the index on the bottom, so it's a little bit opposite from a price chart. We have a solid red line there, and that represents the value of the position at any given price point at expiration. We have the dashed line, which is the theoretical value of the position as of today at any given price point. So As time goes by, what happens is the dotted line tends to gravitate towards the solid line, and if you're in the right price range, you're going to come out as a profit. The challenge to these types of trades, believe it or not, is that the price of the underlying actually changes. It doesn't stay in one place. And if it changes too much, most traders are going to perform what we call an adjustment, where we change our zone of profit. One of the things that attracts traders to market neutral trading in general, other than the need to not having to call direction, are the rule-based systems that come out and they tell you, well, if this happens or the price moves this way, then do that. So if X happens, do Y. Just follow a set of instructions, do this trade every month the exact same way, and you're all set. Now, the good part about these systems is that they're actually really high probability trades, and therefore they do win most of the time, which means someone can come in who doesn't really know a whole lot about options trading, other than, excuse me a second. Someone can come in who doesn't know a whole lot about options trading, and they can actually do okay. So they can do okay for a while, you see, because we haven't talked about the downside of these trades yet. Just like directional trading, a certain rule set only works well in certain market conditions. In this case, a high probability trade works well in a very wide variety of market conditions, but only certain market conditions is the same. There's going to be market conditions, no matter what your fixed rule set is, that's going to cause the trade to lose, which means that the trade can go well for months and months, and you think you're all set, and all of a sudden things change. Now, due to the nature of these trades, when things start to go against them, losses can be quite substantial. Therefore, if the market conditions happen to remain unfavorable for an extended period of time, the strategy may take repeated losses and draw down a lot of money, so much so that it could take years if you're using the same strategy to get your money back. That makes, obviously, for an unhappy trader. And when that happens, what traders usually, they lose faith in their system, and they start the downward spiral to his doom, is what I call it. The trader starts jumping around from one system to another, looking for a trade that's going to work in all market environments. They're looking for the holy grail, the trade that's going to work no matter what and perform well in all market conditions. The ironic part about this search is that because of the high probability nature of these trades, it's really easy to think you've stumbled on a holy grail strategy. You know, when you're really, and when you do that, and you're really, really sure that you found it, you're screwed. And I'll tell you why you're screwed. Because here's what happens. You're going to find the system that's going to seem to work. You're going to take it and you're going to backtest it like crazy. And because you really want it to work, you're going to unconsciously bias your backtesting results to your favor without even realizing it. And you're going to take the trade and you're going to trade it live, and because it's high probability, it might even work, and it might even work for an extended period of time. So what do we do when that happens? Of course, we increase our position size, right? And when we increase our position size enough, we get more and more of our net worth in it. We quit our job. We're finally financially free. Everything is happy in the world. But then market conditions change, and the system stops working. And now that your system no longer works, what happens? Well, you start frantically looking for some other system that does work because what you're doing is not working. So you start doing that, and you start taking these long shots with your trades because you're trading like you really need the money, because you really do need the money. And when that happens, it screws with your psychology. And as soon as that happens, even conditions when the trade would have won before, it's going to lose now because you're not trading it right anymore. So before you know, you've lost tons of money, you're looking for old job back. It's just not a good situation. So the reality is that you would have been a whole lot better off in the long run had you had bad luck when you started trading, and you realized that there really was no perfect system, because then you wouldn't have mistaken your ability to follow directions for your ability to trade, and you wouldn't be in this situation. So speaking of a holy grail trade, I like to bring up iron condors, what we call these high probability iron condors, in the time zone between 2004 and 2006, right? These things did well for an extended period of time in here. I actually knew people who decided they had very simple adjustment strategies. You put the thing on month after month. It didn't make a lot of money, but it made money. And, you know, these people had a lot of money, so they put these really huge trades on, and they do it month after month. They decided they could leave their jobs. They decided they could retire. They knew what they were doing. Well, in 2007, the market conditions started to change. These things started taking losses, and most of the traders were lucky if they broke even in 2007. And if they survived 2007, they got absolutely decimated in 2008. Now, to be fair, there's nothing wrong with a strategy like this. It's perfectly fine. The problem's not the strategy. The problem was that the traders were depending on a rule set that works for most market conditions to work for all market conditions. And then they found out the hard way they were mistaken. And what's worse in this situation, when it happens, they don't know how to adapt. Or put it another way, they never learned how to trade. All they figured out how to do is follow instructions. So that brings the question, if there's no holy grail strategy, what do we do to ensure our long-term survival in the markets? Well, in order to depend on your trading as a long-term source of income, you have to learn how to change your trading to market conditions. And to do this, you actually have to know what you're doing. So the first step in knowing what you're doing is actually understanding how changes in market conditions affect the way a given complex options position reacts. And this takes a lot more than knowing what delta, theta, vega, and gamma are. In fact, let's talk about the Greeks for a minute. There's this big fad that comes in out of options income trading called trading by the Greeks. It's where you come in here and your rule set's based on, you know, some sort of fixed rule set where you say something like, you know, keep the delta of this trade between, you know, positive 100 and minus 100, and keep your delta theta ratio to, you know, some value, keep your delta vega ratio to this and your theta gamma ratio to that. And, you know, can trades work this way? Yeah. I mean, trading by the Greeks, it's perfectly fine. If you have the right delta, theta, gamma, and vega numbers and the right ratios for specific market conditions, it works great. But when you don't have the right limits for the market conditions, it works terrible. So therefore, you know, we've got the same problem with trading by the Greeks as we do with any other strategy, in that you need to choose the right Greek limits, or it's going to result in either you taking losses, or it's going to result in a system that really doesn't make as much as you could be making. So, you know, for example, if you try to hold too tight of a delta limit, and delta is our price movement risk. If you try to hold too tight of a delta limit in a volatile market, you're going to be constantly adjusting your trade and you're going to lose. If you try to hold too loose of a delta limit, which would work well in a volatile market, if you use that delta limit for a trending market, you're going to lose just as fast because the price just keeps moving in one direction, and it's just going to take a loss because you're not being tight enough with your delta. So you have to vary what those ranges are. An even bigger problem when we start talking about the Greeks is that most income traders are only taught about what we call static Greeks. And by static Greeks, I mean what the Greeks are of the position at the specific price point that you're at. And they don't take any regard for what's happening with the rest of the T+0 line. And that's really limiting yourself, because static Greeks are only a really small part of what's going on with your position. To truly understand your position and really know what your risk is, you need to be aware of what we call dynamic Greeks, or how Greeks change with the price movement, the passage of time, and volatility changes, as well as how those Greeks interact with one another at various price points on your T+0 line. So we're not just concerned about the Greeks where the price is, we're concerned about the Greeks where the price is going, and we're also concerned about how those Greeks are going to change when the market moves, and when time changes. So for example, when the market goes up, we generally get a volatility drop. You see your T+0 line. The volatility drop is going to alter the T+0 line. You can't see that. You have to know about that. So that's kind of just a little example about that. So can you learn this type of stuff on your own? Yeah, I mean, I had to take this, and I had to learn this completely on my own. And the reason I had to do it is because there's nobody else in the nobody else out there that I've ever seen that teaches it. And here's the challenge I had with learning how to properly manage a position on my own. The rule-based systems that are available in the marketplace, such as these iron condor strategies and butterfly strategies and calendars, all this other stuff, they tend to be very poorly designed for learning. They have very poor risk-reward profiles. They take on way too much price movement risk, and they have adjustment procedures that often take on too much risk for a beginner to have. This is fine, you know, as long as things are going your way. You can get in there. You can do great. It was fine for me when I didn't know what I was doing, but you know, as soon as things changed, I started taking these really big losses, and I don't mean 1 month's worth of income. I mean losses that are going to take years to make up if I was going to continue to trade the same strategy. That wasn't working for me. I knew there had to be a better way. And when I figured it out, I developed the M3 trading system to help other traders through the same process. And that's what this is all about. So here's an example. If I have a butterfly, and this is just a picture of a butterfly, and say this butterfly had too much negative delta, how am I going to correct that? Say I wanted to bring my delta from minus 100 to 0. I could buy an out-of-the-money call. I could buy an in-the-money call. I could sell a vertical. I could buy a vertical. I could roll a spread. I could roll the whole butterfly. There's probably a dozen different things that I could do, and they'll all correct my static delta. But they're also going to cause the position to react differently depending on what I do. You know, a lot of times I'm going to see traders, they think they're doing the right thing by making a delta correction. In the process, they're making the situation worse because they chose the wrong way to do it. So in order to properly adjust your position, you need to understand how the position is going to change from a dynamic perspective, not just what's going on statically. The M3 is the system that teaches you how to trade a market-neutral position that's very resilient to price movement. It is designed to lose as little money as possible while you learn how to monitor, identify, and control price movement risk in the position. And it helps you understand how to make the proper adjustments to keep your static and dynamic Greeks in line so that you can be in the market learning how to trade properly in a live position without the excessive risk of a lot of other strategies. So this is an example of an M3 entry position. You can see how flat the T+0 line is. The price can move all over the place, and this thing is really stable. And the better part is that the options are placed in a manner that keeps that T+0 line very stable, so you can literally sit outside of the tent. Like, for example, most market-neutral traders, if their trade goes outside of this line, they start freaking out, because this is called the sea of death, and it's supposedly a real problem. I've sat out here for weeks and weeks and not had any trouble. Because of the way I put the options together, I have a nice, flat, stable T+0 line, and I've even won trades with most of the trade completely outside the tent. It's really an awesome system. And you know, because of that, people are able to stay in this and have very, very high win rates. They just simply, they love the trade. I mean, I've had option traders who thought they'd never make it trading options, and they get into something like this, and they just really love it. So that is, you know, one of the things with the M3. Now, of course, a trade like this, it does have a downside, and it drives some people crazy. You'll have somebody who will trade this position, and they'll learn the risk management techniques. They'll absolutely love the trade, but then they say, well, it's driving me crazy because I want to make more money. Well, they realize a problem with that. You see, there's no free lunch in trading, and in order for me to get the type of price movement protection in a trade like this, I had to give something up. And what I had to give up is a high yield. The position is a very reliable, consistent position that does very well in the market. And risk-averse traders, like I said, they absolutely love it. But the yields are not terribly high. Unfortunately, high yield comes with a cost. And that cost is that they're income trades that are high yield are extremely sensitive to price movement. Look at the difference between the dashed line on this trade and the dashed line on the M3 trade. okay? There's a lot of price movement risk here. If you've ever attempted to trade this type of a high-yield iron condor at the wrong time, you've been hammered, right? Because the large price movements can be devastating, and they can result in these really huge losses. So this iron condor, just to take this as an example, it has a risk of entry, a total risk in the trade at entry of approximately $34,000. And it has a maximum profit potential if you were going to expire this around 17,000, a little under 17. When you think about making 17,000 on $34,000, that's 50%. That is a pretty darn good return on your money. But let's look at the reality of a position like this. So first off, it's really unlikely that you'd actually get the maximum potential gain in this because the market just moves around too much. It's a whole lot more likely that if you get a winning trade that went really, really well, you'd probably be looking more in the $10,000 to $12,000 range. That's about 30%, which is still really, really good and also really unlikely. Next, you're going to need some sort of an adjustment strategy because the market usually doesn't stay this tight. And if you're going to do a trade like this long term, you're going to have an adjustment strategy. That adjustment strategy almost always is going to increase the capital in the trade, and it's going to drop the top expiration line or your maximum profit. So the adjustment strategy means more money in the trade most of the time and less profit once you start kicking that off. In addition, the common adjustment strategies to these, when you widen the trade out, you make it very vulnerable to the price reversing on you or very vulnerable to a whipsaw. And they get very touchy that way. So what we have here is a trade that if you have a really hard time with it, you're probably going to have to double your capital. So you'll probably have to have 60,000 in it. You have probably a maximum potential gain of around 10,000 in reality, which puts you at the 15% range, which is still a very decent return. And it's also very vulnerable to a whipsaw, which can be a problem because a lot of times the market will go one direction and turn the other direction. Essentially, you have a trade that's fairly difficult to manage. And most high-yield strategies are going to be like this. They're going to be fairly difficult to manage. They're going to be taking on a lot of risk, and they're going to be sensitive to price movement. Now, to combat something like this, what I did is I created a trade called a bearish butterfly. It's a high-yield, high-probability trading system that's designed to take away a lot of the price movement risk and have a very high probability, excuse me, high probability of winning. So the bearish butterfly is by far the most powerful rule-based strategy that I've ever seen. And it really is still my personal favorite strategy. I know Seth's personal favorite, I think, is the M3. But,
that's correct.
But the bearish butterfly, for me, I really, really like this trade. And the reason I like it is because it's designed to handle as large a price movement as any high probability or really wide type of a condor trade. But it does so with the potential yield of at least 3 times of what an average income trade is going to give you. So this is a position, or it would be an entry position for a $50,000 planned capital bearish butterfly. Right now, as we enter, we have about $12,000 risk. Even with only the $12,000 risk, we may still make our $15,000, which is kind of pretty cool to make that kind of money with only that much at risk. But the reality with this trade is that the market's probably going to move around, and we're probably going to have to scale into the trade, and we're going to increase our capital potentially to 50,000, sometimes more, but on average around 50, or you can keep it at around that level. And we're going to have a profit target of about 15,000, which gives us about a 30% profit target. And the trade's capable of making more, but 30% is usually a really, really good month. But it's going to make it similar to what we saw in the Iron Condor. If we go back to the Iron Condor, one of the things with this trade is the Russell on a regular basis moves 40 to 60 points in less than a week. It can move really, really quickly. If you take a look at the price movement risk in this trade, and the market moved up 40 points in the next couple days, this trade would be down like $7,500. It's almost pretty close to what's maximum profit, at the $10,000 level. and it would be drawn down quite a bit. It wouldn't be the end of the trade, but it would be in tough shape. Also, if the market moved the other way and moved back very quickly, this would also be down close to $7,500. So a rapid price move in either direction is going to really, really hurt this thing, and it's going to make for a rough month for you. If you get into a bearish butterfly type of trade, if we get a price movement up of 40 points the very next day, we're only down maybe $30,000, $3,500 bucks, which is much less than what you would be in a Condor. So it's got a very similar risk profile to the upside. However, if the price goes down, this trade's actually going to be up money. Even with the volatility increase, even with everything else, this will still be up at least $2,500, probably even more with a 40-point drop. So right there, there's just a huge difference in that. That's really cool. But that's not the best part, because with this trade, we actually want the price to go up, because the way that the trade is the adjustments work on the trade is we're actually going to scale in to the position, or actually make the position bigger when the market moves. So, for example, this is what a fully scaled in bearish butterfly is. And when the market cycles do what they usually do, where the market goes up a certain amount, usually 20 to 40 points, and then the market comes back, this puts you in the center of a really wide, high-yield position. A high gamma position, yes, it's sensitive to price movement, but it's also a position that gains value very, very quickly. And usually the way you scaled into it, if you can scale into it properly with favorable market conditions, this thing puts you up a lot of money really quick. So that's one of the reasons that I really, really like this trade. In the Iron Condor trade, if you got into a position where you had a large up move and you had to adjust the position to the upside, and you're doing a typical vertical spread strategy where you move, and we're going to show you that in a minute, where you move one side of the wings out and the market reversed on you, you would actually be in a position where you could take a really hard loss to the downside, because they're very vulnerable to whipsaws. The good thing about this bearish butterfly is we actually want that to happen. So if the market goes up and we get scaled into our position, we want the market to pull back. In fact, we're almost depending on the market to pull back to put us into this nice wide position. So that's the really cool thing about that. So the entry, like I said, the entry.
And I noticed, John, that makes it one of the weirdest options neutral trading strategies, in that you're actually, the crazy part is you sort of want the trade to go against you initially, because the market always had this tendency to rally, and this rallying gives you the opportunity to get all of your butterflies in, and then the market, inevitably corrects or eventually, has some profit taking, and that brings you into the body of the butterfly. So people, in a sense, you sort of want to get down money on this trade initially, and that's something that people, would be surprised by this strategy. But if you think about it, a strategy based on the market always eventually taking some profits and retracing a little bit is all you really need to make this strategy profitable most of the time. Right.
And it's a very powerful strategy. It works in a lot of different markets. However, it is a rule-based strategy, right? So it does have a weakness. And if you want to make a lot of yield, and this is a high-yield trade, if you want to make a lot of yield, you have to take on some risk, and you got to take it somewhere. In the case of this trade here, what we're doing is we're putting all our risk to the upside. What that means is if you get into a market situation where the market just goes up and up and up, and it never retraces, that's the losing scenario for this type of a trade.
Right.
And that's the weakness, a very large sustained upward move, particularly in low volatility. So just to be clear, though, the trade can withstand a very large up move. Especially in high volatility, it can withstand a very large up move. But in low volatility, it gets a little bit sensitive to that. And it tends to create some losses. So even with this trade, a really powerful system that happens to be my favorite system that's rule-based, we want to make sure that we avoid certain environments. Because the simple fact is that there are going to be situations when it's really beneficial for you to be in a high-yield position that might be sensitive to price movement, but goes for maximum profits. And there's going to be other times when you're going to want to be in a much more defensive position that's going to protect you against price movement. And in order to get the best performance, you're going to have to match those trades with a market environment. Because if I'm in this type of a trade when the market is just kind of sitting there, I don't make any money. I mean, I'm giving up a lot of potential profits. It's not I do make money, but I'm not making anyways near as much money as I could be making. I'd be making a ton of money in a position like this if the market wasn't moving. But on the flip side, if the market is moving, I don't want to be in a position like this because I'm going to take on like big losses. I want to be in a position like this where I can let the market wander all over the darn place and just take a small profit out of the market. So how do we know which type of a position we want to be in? What if there were a simple way, without looking at charts or guessing market direction, to determine which type of position to enter? And the great thing is there is. This is going into the RUT trade. The RUT trade is going to use a simple and effective entry test that helps us determine whether the market makers are expecting a large, unpredictable price movement or if they're expecting more of a slower, more predictable type of a move. This is an example of how we do an entry test on the Russell 2000. We analyze a 50-point wing butterfly that has its short strikes 15 to 25 points below the money, and then we see what our delta would be if the price were actually 20 points over the short strikes. So if the Russell's at 841, we could analyze a 50-point wing butterfly with the short strikes at 830. We can see what the delta of our position would be if the Russell was at 850, and from there we can determine whether we should enter the market in an aggressive, high-yield position where we go for maximum profits, or if we should be in a more of a protective, low-risk position so that we can avoid drawdowns. So here's an example of a butterfly that's 30 days to entry, 50-point wings, 20 points behind the market, and we have a delta of minus 202. That's a fairly steep delta. That's telling us that there's really not a whole lot of risk or price movement risk right now, as things are right now in the market. In other words, the big players in the market, they're not really concerned with the market coming down or being overly volatile.
Mm-hmm.
Graphically, that position looks like this. It's just a butterfly with a fairly steep thing. On the other hand, this is another butterfly, 30 days to entry, 50-point wings, 20 points below the money. I have a delta of minus 60 here.
Mm-hmm.
Minus 60 to minus 200, that's a really huge difference. There's a big difference there. And what this is telling us that the market's essentially going to be too volatile to put us into some sort of a really high theta type of a trade, because we're probably going to get knocked out of the position, or at least it's very likely we're going to do that. So in this case, we would go for a more protective type of a position. What if conditions, but here's the question, right? What if conditions change after the entry? Because I can come in and I can analyze the market and I can say, all right, you know, I can see on the charts maybe that we don't have a whole lot of price movement going on. I can see in my entry test the skews that the market makers are saying, we don't think the market's going anywhere, or we're not concerned with large price movements. What if that happens, and then I go in and my market conditions change? Well, that's okay with the RUT trade, because what happens with the RUT trade, it has an adjustment sequence that makes the position less sensitive to price movement as the price comes down, and more sensitive to price movement as the price goes up. So if you entered the trade in what we call a high yield position and the market goes down excessively, the sequence is going to shift you from a highly aggressive high yield position to a defensive position that can much better handle these large price movements, and it's going to improve your chance of winning the trade. The opposite's also true. If you enter the market in a protective position and the market transitions into this upward grinding, low volatility environment, then the RUT trade's adjustment sequence gradually shifts the trade into a much more aggressive high theta type of a position to maximize your gains in those conditions. We can do this because the RUT trade has 7 different configurations. It's almost like having actually 7 trades in one, and they're all designed for different specific market conditions. Excuse me. And the bigger benefit, however, besides having these 7 different market configurations that you can swap back and forth between those, the biggest benefit is that it actually teaches you the mechanics of how to dynamically change your trade configuration on the fly from a position that's extremely resilient to large price movements to one that's a lot more aggressive. And by doing this, you're learning to systematically manipulate your T+0 line in a way that's understandable, so you can create a position that reacts the way you want it to, which allows you to have greater understanding and more control of your position so that you can trade more effectively. So I'm just going to go over a little example of here. This is February 2014 expiration. My red circle represents 30 days to entry. During this time period, we had about a 100-point drop in a fairly short period of time, and then we had a 80-point reversal within our 30-day period. That's a pretty darn big move. Now, if you're going to enter the market in a typical 30-day to entry iron condor with 30 delta shorts, you'd be into something like this. Now, I'm going to give this position the benefit of the doubt because you can see with the way we're entering this, we're actually negative delta, and we know the market's going down. The reality here is most low probability iron condor traders, they're going to add a call here, or they're going to actually shift the whole position a little bit to the right so that they're flatter delta. But we're just going to leave this negative delta because it's going to work out a little bit better this way for us. So what we're going to do is, for an adjustment strategy, is we're going to play this like we are a high theta trader. In other words, we're always trying to maximize our theta. So the people who trade this way, what they're going to do is, if the market goes against them, they're going to take say if it goes against them to the downside, because that's the way it's actually going to be going, we're going to take this wing and we're going to roll it back. When we roll it back, we're going to lock in a loss. We're going to drop our expiration graph down. And at some point, we might have to add capital to the trade, because if we have to roll this back more than once, if we have to do it maybe 2, maybe 3 times, then eventually this expiration line goes below 0. When that happens, what most of these traders are going to do, they're going to double size their wing here to bring more credit into the trade. And if they absolutely have to, if that's not enough, they'll actually take this upper wing and they'll roll it back down. That would be what a typical high theta condor trader would do. This is what a rock position looks like on entry. This would be what we call a normal entry, or an entry when the market is not expected to be volatile. This is also negative delta, but the trade is designed to be negative delta on entry. It has an adjustment strategy that, kind of like the bearish butterfly, where you almost want it to go against the trade a little bit. And the optimal thing for this trade would actually be for the market to grind up to around 1200 or 1210, and that would be a really nice situation for this, where this would make its maximum profit, because this trade changes as the graph is going to change as the price goes up. So it allows us to go in negative delta, and this is going to be a similar negative delta to what we have on the Condor. And you'll notice we do have a very aggressive high gamma position here that is very similar to the Condor. There's not a whole lot of difference in the T+0 line. However, these T+0 lines aren't going to react differently. Our adjustment strategy here is just going to be the rock adjustment strategy, and we'll show you that as we go along. So if I pop this ahead 5 days, the Russell's down 50 points in 5 days, which is a pretty big move. On the Condor, what we would have to do is we'd have to take this lower spread and we rolled it back. We now have a little bit more money in the trade. Our profit potential on this thing's dropped from, I think it was all close to $20,000 before, is all the way down to about $3,500. The trade's down about $2,500. That's not a big deal for this trade. It's actually not that uncommon. And because this is a high theta position, this will make up its value very, very quickly if the market stops. If the market doesn't stop, well, that's another story. but if it stops, that would be the case. On the RUT position, we have an adjustment strategy. Excuse me a second. Had to clear my throat. I don't want you all to listen to that. Okay. We had a adjustment strategy that turns this into what we call an M3R position. And this is a position within the RUT trade. And what it does is it flattens our T+0 line out so that we're very resilient to large price movements. Our first adjustment rolled us back a little bit. Our second adjustment put us into this position here. Now, notice also we didn't get drawn down. We didn't get drawn down because this is a very, very aggressive downside adjustment strategy. Because we know when the markets come down, they tend to get more volatile, and when they come down, we want to flatten out. And that's what this principle is based on. So this is the type of a position you'd be in if we got that same 50-point move in this trade. Going forward, the market continued down. So after we've been in the trade 12 days, or 7 days more than before, we're down a total of 90 points in 12 days, which is it's a very aggressive move, but it's not all that unusual for the Russell. And this is what the position looks like. We've had to roll back this wing again 2 more times, and because our expiration line went below 0, we actually had to come in here and double size, and even that didn't bring us to 0. I had to take my upper wing and actually roll it to the left. So now I'm basically playing in this trade for break even, and I'm down about $10,000. Now, risk management guidelines for most people would probably actually pull them out of this trade, but we're going to stay in if they're responsible, because we just want to show you what's going to happen. But if the market settled here, it is possible you could certainly break even if the market settles down. With the RUT trade, we continue adjusting down with the M3R guidelines. One of the things that we do when the market comes down, we know, if you look at history, every single time you get a really harsh down move in the market, you're going to get a really harsh up move. You're going to get a very strong bounce. We just don't know when that bounce is going to happen, and we don't know how big it's going to be. But we know it's coming. So this trade is actually designed to really shave off the upside risk as the market comes down. So when you get that big bounce, you don't get hurt. You're not going to make any money necessarily, but you're not going to get hurt, because at this point we're kind of in the trade to make money, but we're also in the trade for safety because the market's moving like crazy. So if the market continues down, we continue with the same adjustment strategy. We are drawn down a little bit, but nothing too serious. Looks like a few $1,000s or something. So this is what this would look like. If we continue forward, we got our bounce. We went from the market at about 1090 all the way to 1160. And with the Condor trade, we were basically playing the same game. We had rolled this upper strikes way down here. Now we had to roll it way back in the process. To keep our credit, we also had to roll up our lower side. We had to keep double size the whole time. And now we're in a position where, you know, you're not down quite as far, but this is pretty much a no-win situation. This is actually about 3 days to expiration, and it's a really risky position. It's probably not even worth staying at this point. But if you wanted to stay in it, I did trade this to the end in the next 3 days. This would have made it worse because we continue to have fairly decent market moves, and it actually drew us down a little bit more. On the other trade, the RUT trade, we got our bounce, and we came all the way up to 1160, and that trade essentially transformed back into this high theta position, because the RUT trade, it assumes that when the market goes up a lot, that the market is going to tend to run sideways, which tends to happen. The market tends to get a little bit sideways when it goes up a lot. And we get into this really high theta position to take advantage of this. You know, the same thing happened here, where if you ran this into expiration, we still potentially have a $5,000 profit, but we are in a high gamma position, very close to expiration. A large market move is going to kind of knock this down a little bit. So we did get a fairly decent move down in one day, and we got a decent move up the next day. The results were, if you stayed in this was slightly profitable. But the point is, it never really drew down a whole lot of money, and we were never really in trouble. So, and that shows you how you go from a high theta position to a very protective position and back to a high theta position again. So far, we've gone through 3 programs: the M3, the Bearish Butterfly, and the RUT trades. And you can see that each of these programs by themselves, they're very powerful trading systems, and that's without any technical analysis on the price charts whatsoever. One of the problems that we discussed at the beginning of the presentation is that there may be perfect trades for specific market conditions, but there are no perfect trades for all market conditions. And this is true no matter how powerful your system is. These are very, very powerful systems, but they all have their weaknesses. And in order to depend on your trading system as a long-term source of income, you have to learn how to change your trading with market conditions. And we said that the first step in adapting an income trade to market conditions is understanding how changes in the market conditions actually affect the way the complex options position is going to react. Well, the M3 teaches you how to do that. It teaches you how to understand how your position is going to react, and it does it in a mild risk-controlled manner so that you can confidently control risk and reduce losses. Next, we discussed how some people, once they've learned the lessons in the M3, they want more money. So then we introduced the Bearish Butterfly. But there was a challenge with that, right? The big yield means taking on big risk, which is fine in the right market conditions, but it can be a real problem in the wrong environment. So to remedy this, we introduced the RUT trade, which uses a simple and effective way to analyze the market without looking at charts. By doing this, we can see what the big guys are thinking, and we can adapt our entries to maximize our chances of winning, or at least entering in the right configuration. And more importantly, though, the RUT system is going to teach you how to make adjustments that gradually transform your position back and forth between one that takes advantage of lower volatility to one that's suitable for more high volatility environment, so that you don't just have to sit there and take what the market gives you. So if you're like most rule-based income traders right now, you should be completely amazed by this, because these are just really great systems, and you learn a ton. This information just isn't available anywhere in the market. But the best part is that we haven't even discussed the most important steps in your long-term success as a professional trader yet. So in order to really get the most out of your trading and ensure your long-term success, you need to go beyond basic rule-based trading. What if we took these 3 systems and we combined them into a high probability system that takes advantage of what we see in the market, and yet we keep them high probability trades so that we can withstand large price movements against the position, and then we take technical analysis to learn how to analyze the market as an income trader, not as a directional trader, but as an income trader, and we use that information to create a customized plan that's designed to skew the position just enough to allow the possibility to make a lot more money while keeping your risk down at a minimum. And what if we threw in a section on trading psychology so you can keep the proper mindset while trading, and then showed you how to get the very best trade execution so you can really maximize the profit potential in your trades while you reduce risk? That's what the M21 program is all about. The program, it starts off by teaching you about the winner's mindset and the successful of masters so that you keep your mindset in check. We teach you how to get the very best trade execution on your trades by analyzing synthetic trades and using market movement to your advantage. And we teach you multiple ways to analyze the market by diving deep into technical analysis so that you can create high probability, high yield trading plans that best match the market environment and set yourself up for the very best chance to maximize your profits and minimize your losses. Now, before we go any further, I realize that technical analysis is a really, really sensitive subject for a lot of market neutral traders. Usually it's because they either don't understand technical analysis, they've never really spent the time to do it, or they've actually tried technical analysis to call direction in the past, and it simply doesn't work. And you know what? You're right. Technical analysis, it doesn't allow you to reliably call direction in the market. I agree with that 100%. But that doesn't mean that the information contained within the technical analysis isn't useful. I like to compare technical analysis to forecasting the weather. Because, wherever you go in the country, when the talk turns to the weather, someone always mentions how often the forecasts are wrong. Yet we all pay attention to the weather forecasts on a regular basis. Why do we do this? Well, it's because even though the forecast often is not perfectly correct, it's usually close enough that we can make plans to get the most out of our upcoming week. So, for example, I was talking to a trader that I coach out in Oklahoma a few weeks ago, and he's telling me how they might have to cancel his meeting because we had that we had scheduled together because the forecasters were predicting one of those really horrifying tornado outbreaks that they have down here. Now, I don't know about you, but I've seen what a tornado does, and if the conditions are favorable for a tornado, I want to be prepared for it. Therefore, I'm going to make different plans and take different actions than I would if there was virtually no chance of having a tornado if I lived in that area. This is kind of how we have to look at technical analysis as an income trader. We're going to go in, we're going to observe what's happening in the market by using past patterns and cycles to forecast the general conditions for the duration of our trade. Yes, when we do this, we're sometimes wrong. Matter of fact, we're usually partially wrong all the time, but we're usually close enough that we can make a dramatic improvement in our results. Think about it. Just by identifying the likely market conditions, we can avoid entering trades that are destined to lose. We can avoid placing adjustment points where the trade is likely to get whipsawed. We can get better fills on entries, exits on adjustments, and most importantly, it helps us recognize when the market conditions change so that we can adapt or change our strategy before we get into too much trouble. And all that equals more money in your pocket. So, the bottom line is technical analysis is an extremely valuable tool, and I'm going to go as far as to say you'd be completely foolish not to use it. To me, income trading technical analysis is even more important to income trading than it is to directional trading. And, trading without it is like running across your busy street with your eyes closed. I mean, it can be done successfully sometimes, but eventually you're going to get run over by a car, and your chances are a heck of a lot better if you open your eyes. So what we're trying to do with the M21 trading system is we're trying to open your eyes to help you avoid the dangers as well as the opportunities in the market. And once you're aware of the opportunities and the pitfalls that are present there, we then teach you how to take advantage of them by showing you how to create a customized trade plan for the month using the M3, the Bearish Butterfly, and the RUT strategies that's designed to take advantage of those conditions. So we do this by teaching you to analyze the market in multiple ways. We're going to look at price patterns. We're going to look at support and resistance areas. We're going to go through multiple time frames. We're going to be long-term, short-term, intermediate term. There's a full technical analysis course in here on how to do all this stuff, and it's not geared toward directional traders. It's geared towards income traders. We look at other things like our long-term price channels. We look at our shorter-term price channels. We do things like looking at moving average extensions. How far is the index from each of its moving averages, the 200, the 20, the 50? How far does it ever go from those averages? How overextended are we? Because sometimes people think we're overextended in the market and we're not. This is a way to help deal with that. We look at maximum runs. What's the maximum amount of movement the market's had in one direction in a given time frame for the last 2 years? What's it likely to be now? What are the past cycles? How far has it been moving lately? All this information is going to tell you what type of trade you should be in. But essentially, and we're also going to look at cross-market analysis too, because we're not just going to look at the Russell. We're going to look at the NASDAQ. We're going to look at the Dow. We're going to look at the S&P and get an idea how those are trading, because one of the things you'll notice is that the indexes, they interact with one another in a certain way. So we're going to take this information and we're going to assemble it in a manner that helps us determine first where the price is very likely not to go, because as income traders, it's less important where the price is going to go than it is where it's not going to go. Because when you know the price isn't going to go somewhere, or you have a high confidence level, you can take risk there and you can actually make a lot more money somewhere else. So that's very, very important. But we're going to take all this information and we're going to set multiple scenarios. We're going to say, what's going to happen if the price holds the daily channel? If it happens to hold the channel, what price movements can we expect? What price movements can we expect if it breaks the channel and it continues higher? What price movements can we expect if the market holds resistance and it comes back down to its next major support level? And we're going to take into consideration all these scenarios, and we're going to come in and we're going to make a set of trade design specs. So in this situation, we want to put a trade. We think that normal market movement, because of just the way the market's been lately, could be between 760 and 945. That's a huge range, right? That's huge. Mm-hmm. Now, just that in itself, if you're expecting that you could have a range like that, you can't be in a high theta trade. It's like committing suicide into the market that way. So you know right off you need to be in something that's going to be a little more forgiving the price movement. We also have a tighter range that the market's more likely to hold, which is 790 to 945. Still a huge range. But we also have another range that we consider the market very likely to hold, which is going to be from 810 to 890, and we go all the way to the point to picking a range where we think the market's going to expire. And we're going to set up a trade that'll handle a move between our wider ranges that we're expecting. We'll win something in the little less of a range and come in for a big win if it actually does what we think we're going to do. And we'll set up on a plan like this, right? So if we're 30 days to entry, this is what would be what we call an M3R entry, which is part of the RUT system. And you could set up multiple scenarios here. It doesn't have to be an M3R entry. It could be a regular M3 entry. It could be a bearish butterfly, all depending on what our analysis tells us. So every month we're going to have a different trade. But this is a really hard month to set up because we might get this huge move. As a matter of fact, we might even be better off going into another month and giving ourselves more time to expiration. But if we wanted to set something up 30 days, this is a trade plan that's going to allow me to do that. It's a trade plan that I say if I stay, my most likely range is between these yellow lines for the trade, right? And if I stay in that likely range and the market expires where I think it's going to, I'm going to make 15+%. I know it doesn't look like you can right here, but we'll show you how you're going to get that. But I'll make 15%. If the market goes outside that, that is more volatile than I expected. I'm going to lower my profit target. I'm going to trade a little bit differently. I'm going to go for a lower profit target. I'm setting technical exit points. If the market goes over 945, I am exiting the trade. I don't care if I'm up money or if I'm down money or what the deal is. That's signaling to me that the market's doing something it hasn't done in over 2 years. It would be very, very unusual. And I'll do that both the up and the bottom. And this is in the range of what I thought I might trade in, but if it actually hits that, I'm going to really lower my profit target. So from there, once we know what we're trying to get out of the trade, we're going to make an adjustment plan for a trade to make it that way. And I know a lot of you guys, if you have the RUT system, you'll understand this. If you don't, you might not. But I'm going to essentially trade this trade one way as an M3R like it is now and go for 5% to 10% profit if it stays in this range. If I break down under this range, I'm dropping my profit target. I'm trading it as an M3 because I wasn't expecting that. If I go below here, I'm going to exit. If the market comes up to where I think it's going to be, I carefully planned these strikes on entry so that if the market goes where I think it's going to go, I'm going to go into what we call a RUT trade, an 860, 900, 920 RUT trade, and I'm going to take advantage of this by making 15+% here. And if the market goes further than expected, I take my go into bearish butterfly guidelines, which maximizes my theta, and my objective is to get to break even and get out of the trade. And then, so my objective changes, and then I exit the trade again if it comes up here because that's kind of crazy. So what we're trying to do is we're trying to put together an adjustment plan and an entry plan that gives us the best possible odds of a winning trade with minimal risk. Excuse me. So you put together a system like this. So you take a system like this, it's really, really powerful. It's incredibly powerful. And when you take this and you add the trading psychology and the trade execution segments of the program, and then you add the interactive workshop that we put in here where you can actually see us custom create these plans so you know how to do it. It's just amazing. Now, the best thing about fully understanding this and taking these concepts in is that when you fully understand how to trade, how to analyze the market and how to custom design a high probability income trade around what's actually happening in the market. The best thing is that you can stop worrying about when your black box trades stop working. You're not in a situation where, hey, I got this trade from somebody and it used to work and now it's not working anymore. You can stop worrying about the need to go out and frantically look for the next new fad in trading systems. Instead, you can come in here and you can constantly identify and adapt to prevailing market conditions, and in the process steadily improve your trading while the others are just flailing around trying to find the next new thing in trading and not getting anywhere. So this is a really amazing set of programs, and I hope you take the opportunity here to improve your trading and improve your lives.